Let's tackle the biggest challenge with VA loan assumptions, the gap. I'm going to walk you through gap financing on assuming a VA loan today. Hey everyone, I'm Jason Wood here, the VA loan guy with over 2 decades of lending experience and one of the nation's top VA lenders. I have helped thousands of people navigate the VA loan process. And today we're going to break down for you how to do gap financing on a VA loan assumption. So imagine you're buying a $500,000 house and the existing loan that you want to assume is $400,000. Well, there's a $100,000 gap between the loan amount and the purchase price amount. And not everybody has $100,000. So how do we finance it? How do you bridge some of that gap? I'm going to show you 4 ways to bridge that gap between the existing loan amount and the purchase price. Option 1 is a second mortgage. This can come in the form of a home equity line of credit or a fixed second mortgage. A conventional second mortgage in today's environment runs anywhere between the high 7s and 9% for an interest rate. In order to qualify for it, you have to have a minimum of a 680 credit score, no more than a 43% debt to income ratio, and the loan amount needs to be at least $50,000 for our program to work. So let's say you have a $100,000 gap that you need to finance on a $500,000 purchase. Our loan program requires that you have a 10% down payment. So now the gap required is $50,000. We can finance that $50,000 in either a home equity line of credit or a fixed second mortgage. Number 2 is personal savings. If you've been saving up to buy a house and you have the $100,000 to cover the gap between the existing mortgage and the purchase price, in our example is a $500,000 purchase price, a $400,000 existing loan, and $100,000, that's an excellent way to get the most bang for your buck on that super low interest rate on the loan that you're assuming. Third are gift funds. When you're assuming a VA loan, it's actually allowed to use gift funds. So you can get money from a family member or a friend in order to help you cover the difference in that gap. Now, we will have to prove the source of those funds. So whoever's gifting you the funds is going to have to be okay with sharing their bank statement where they pulled the money out of to give to you and sharing that with the mortgage lender whose loan you're assuming so they can validate and verify that it came from a true and original source and it was not tied to financing. Because if it was tied to financing, now they have to do the debt to income calculations to make sure that it works. You're also going to have to include any transfer documentation. So if they wired it to you or cut you a check, that documentation is going to be necessary. Make sure it is not cash because cash isn't traceable and that will be the easiest way to get declined on using the gift funds for this acquisition. The 4th option is seller financing. If you can convince the seller to finance that difference for you, that is one option that's going to be a really great option for you because then you're not going to have to come in with any down payment if the seller's okay with it. One thing to note though is you will have to make sure that this is approved by the lender on the loan that you're assuming. Some of those lenders won't allow for seller to carry a second mortgage for you, and some of them won't even allow me to provide a traditional second mortgage for you. So that's going to be an important question to make sure that you cover when you're trying to bridge this gap. So now here's where it gets interesting. You can actually combine all of these things into one. So let's take an example here. A client of mine, Tom, he was looking to buy a $500,000 home with a $400,000 existing first that he was assuming. He had a little bit of his own money saved and he had some gift funds for the down payment. He had about $50,000 combined between those. So we used the gift funds and his own personal savings for the $50,000 down payment. And then we financed his second mortgage for $50,000 on a home equity line of credit, which generated him a monthly payment of about $333. Compare this to if you were able to finance the whole $100,000 at over $700 a month, you're looking at a $450 a month payment savings by using this combinations. And I think this is one of the best strategies. The other thing to be cognizant of is sometimes these equity gaps can be much larger than $100,000. Homes have appreciated quite a lot since 2020 and 2021 when these VA rates were so low and so attractive to us today. There could be $200,000, $300,000, $400,000, $500,000 in difference between the existing loan and the purchase price that you're looking to acquire. While you can finance most of that gap, one thing that's going to be important to understand is how are you going to pay that loan back? Because oftentimes people will take the home equity line of credit option because it offers the lowest monthly payment, but you need to have a good strategy and a good plan to pay that debt off so you can really reap the benefit of that loan that you're assuming in the 2s or the 3%. So A lot of people have had inheritance money on the way, maybe another property that they're getting ready to sell. It's just the timing didn't work out. Maybe you're in a position where you get large bonuses or commissions at work or stock options or things like that. Those are really good plans to make sure you have in place if you're taking out a very large second mortgage for this gap financing, to make sure you don't end up putting yourself in a financial pinch. So how do you choose which one of these options is going to be the best for you? Well, first thing you need to know is, what does your credit look like? You're going to have good credit in order to get approved for the second mortgage. What does your income and your debts look like? If you're super debt heavy and it's really tapping you right now, then chances are good we may have to assess what we can do to reduce some of that debt so that you can qualify. The other thing to consider is, what is your monthly payment comfort factor? And then what's your timeline? How much time do you have to accomplish this? And importantly also, how much time does the seller have to sell their house? That's an equal part of the equation that needs to be covered. We got to make sure that the seller's on board to do the VA loan assumption. Sometimes the VA loan assumption can go nice and quick in 30 or 45 days. Other times it can take several months up to a year. So we have to make sure that the seller is going to be on board, and also that the timing works for you as well. So some common pitfalls I see with people. I've helped thousands of people with their VA loans. And the common pitfalls that I see for people is not starting the process early enough, waiting until they find the perfect home, and then trying to rush through the process, not getting all of their paperwork in or getting it in on time, or even during the process, not being responsive to the lender, signing things or providing documentation as required. These are all huge pitfalls that can have some pretty negative consequences for your home purchase. Now that you understand your options, here's what I want you to do next. Scroll down to the description below, download my free gap financing calculator, and also schedule a one-on-one session with me or somebody on my team so we can walk you through this process and get you properly pre-approved. Don't forget to subscribe, hit the notification bell, and we'll see you on the next video.